Hello, 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 everyone. I am Rosalind Brown of Your Wealth Guidance, where we help Black women create their financial independence map and identify the tools for success so you can live life on your own terms. Thank you so much for joining us again for another great Money Monday on a Tuesday. Be sure to subscribe and turn on notifications so you don't miss any of our future speakers. And today we have a great speaker. This is a time of year, most people don't start thinking about taxes until January, but by January, a lot of the things that you can do are over. And so this is actually the time that you should be thinking about things, putting things in place, get the receipts out your shoebox, all those kind of things. And that's why we're having this conversation in November and not waiting until January and you're scrounging and you're like, oh, I wish I could have done that. I wish I could have figured this out. And so we have Rose Brown today. She teaches and writes to empower her audience with the tools and knowledge they need to overcome financial burdens in business and in life. Her expertise stems from years of experience and knowledge about money, personal finance, and business. Rose is the instructor of a series of financial literacy programs through her company, the Accountant Therapist LLC, and a nonprofit called Be Resilient Jamaica, where she works with inner city youth in Jamaica, of which she is native. So I am so happy to have you here because one, we see a ton of, you can write everything off. You write off your car, you can write off, everything in your house, your Apple Watch, your iPhone, like all of those kind of fancy things. And folks are like, oh, that sounds good. Like I can write off everything and have this huge tax return later on, not knowing that everybody can't write off everything.
Exactly.
And so this is a great time for us to talk about kind of what are some of those things that might be misconceptions or things that we should be thinking about and plotting and planning today as we kind of plan for the end of the year.
Absolutely. So the first thing to note is no two persons are alike, no two industries are alike. Therefore, what that means is, what your industry is doing is not the same as what another person is doing. So a person may be in the finance industry where, the way they carry themselves or, the places they go look a little bit different, right? Versus if you're driving a truck, you may not be going to the same meal places that these folks are going to. So it's important to know your industry. And it's also important to know what is an ordinary and necessary business expense. So that's the first thing first. I know in my series or that newsletter that I wrote, can I deduct it? Right. So pretty much it first starts with, is it an ordinary and necessary business expense? Now, depending on your industry, it could be, right? Depending on another person's industry, it may not be. But ordinary, is this something typical that's happening in your industry? Can we, go to your competitor down the road and see similar types of expenses? Or is it necessary? Do you need it in order to increase your bottom line, to grow, to sustain your growth, those sorts of things? So we have to determine, does the business expense fall within these two categories? Then, hey, is there a true business purpose behind it? Because if you can't prove these things, it's essentially lavish and non-business related.
And so when people think about like ordinary and necessary, kind of, I guess it depends on what you're doing. So you could be doing the same thing, even, if you do nails, some people are serving wine at the nail salon and some people are like, no, just come on in here and get your nails done.
Exactly. And I think that takes us to facts and circumstances. In the tax code, you can write off almost anything, not everything, but almost everything, anything. And what that means is you have to create the situation for the facts and circumstance to fit so that the expense would be ordinary and necessary. And I love that example because, the two salons can be in the same neighborhood, but their prestige is a little bit different. Their clientele is a little bit different. Therefore, their expenses will look a little bit different. So the person or the nail salon who is a little bit more prestigious can substantiate the need for, bottles of wines, things of that sort, versus the one down the road where, hey, what else do you have going on? Because even if the IRS were to come and investigate, what you have going on, they're looking at different things, not just, oh, hey, you have wine. Why do you have wine? Right? It's, why do you need the wine? Is it necessary for the business?
So you can have wine. You can write.
And
Maybe
they,
not a part of everyone's business.
listen, exactly.
Now, one of the big things is the write-off for business meals. And so I know
Mhm.
a lot of people are like, oh, so does that mean if I, eat out by myself or with my homegirls, or if I go to brunch,
Mhm, mhm.
how free is that? Are you going to happy hour and keeping receipts for all of your happy hour events and saying, yep, I'm gonna write all those off. So, drinks on me.
So, I mean, unless you're, and I can't even say this, but unless you're there sitting, literally talking to yourself about business and, jotting these down, it just won't happen, right? So, us as business owners, you can't just go out by yourself unless you're traveling away from home overnight and you, of course, need to buy food to, eat and you're overnight for the business. Now, if you're just going out by yourself, just, oh, I'm going to lunch. No, only way it's a deductible business expense is if you're out with your colleagues, you guys are talking business, your employees, right? A prospect, a client, those sorts of things. So essentially, it has something to do with the business. Some sort of talk about growing the business, sustaining the business, helping it in any shape or form. So going out just by yourself, it's not enough. And sometimes folks oftentimes overlook being able to write it off, right? Some overdo it, some don't do it enough, right? So a person may go out with their spouse and they're literally talking business. That is a business expense, right? But at the end of the day, you need to be able to substantiate that. What that means is, of course, you want to make sure some way, somehow you're capturing a copy of that receipt, okay? Save it somewhere, archive it electronically somewhere, and note why. What was the purpose of that business meal? So even if you go out to with your spouse, okay, what did you guys talk about? That's it. And really, within a tax code and even within an audit, what they want to see is substantiation. Our words mean nothing in an audit. Your documentation will be your weapon in an audit.
Now, if you're out, does it matter if the meal is $30 or $300? So y'all out, eating at the Applebee's versus eating steak and shrimp. Would both of those make sense?
No, because it goes back to that ordinary and necessary. Um, I mean, if you're out by yourself, first and first, it's not a write-off. But if you go out with a client, could be. You need to document it. If you go out with your employees, could be documented. But if it all depends on the facts and circumstances. Like again, if you're trying to look for a high-end client, gotta feed those folks the proper things to bring them in, right? But if it's just a quick, oh, staff meal, we're gonna run over here, we're gonna grab some, Panera bread, and the bill comes up to like $50. Okay, that's different. Mm-hmm.
Now, Simone has a really good question. She says, what if I work for an influencer and
Mm-hmm.
she subscribes to her Patreon or YouTube membership after she starts working for her? So she's paying that kind of monthly membership fee to this influencer that she's working for.
She's working for an influencer in which she's paying a membership fee to.
Yeah. And I'm wondering, Simone, you might have to give us a little more color around that. Is
Yeah.
doing like marketing for them? So you're kind of looking to see what's kind of behind that paywall. What type of services are you providing for them? I'm assuming you're not kind of a W-2 worker, but maybe some type of,
Independent
yeah,
contractor.
and that might give us a little more color around there. Simone, tell us a little bit more there. Lovely Day, she says, even if you're doing your monthly meeting minutes, and so I'm guessing she's saying, does she need to do additional documentation if maybe this food is a part of their monthly meeting?
If it's a part of their monthly meeting, just make sure you document it somewhere. It doesn't have to be all over the place in multiple locations. But what you want to do when you're documenting that meeting, right? Attach a copy of the receipt to the meeting minutes. This way, it's substantiated there. You don't have to do any extra note because everything is right here. We ate while we were talking, and that's that.
That makes sense. Now, Simone she said she's a contractor doing assisting duties for that influencer. So she's doing some type of assistant type work. And then she has subscribed to the YouTube membership and the Patreon membership as well. So she's wondering, can she?
So her subscription to the influencer is independent of her services to that influencer. If it is independent, then she do have the opportunity to write that off as a business expense because she needs it in order to provide the services.
See, Simone, you got something else to get your receipts in order for. And that's a good thought. It's just things like that that people aren't necessarily
Small things, exactly.
thinking of. And like Lovely Day, she's having these monthly meetings. And oftentimes we have a monthly meeting where either one, we're like, hey, you want me to order you something? And, I'm ordering something, it's going to be there, whatever that is. And if that's the case, to kind of formalize it and say, we always eat Panera. Let's just go ahead and order it and put it
Hmm.
that and kind of make it as that monthly meeting.
Yeah,
So
and I
love
mean,
is a
I
really good.
can't really see anyone, and really in the business world, who's having a meeting without food or coffee or something. So it would be crazy for, the government, the IRS to think, oh, they weren't eating while they were meeting.
Everybody, yeah, don't invite me to no meetings if y'all know. Now, this is one I've seen a bunch of in terms of writing off travel. So I've seen a lot of this, especially on social media. They're like, "Hey, get a few of your friends together, go on a trip, talk business, boom, free
Mhm,
vacation."
mhm, mhm.
Um, how much? How much can you do that? Does it make sense? Is that something you can actually put in place? Are all of us, going on vacation every weekend and writing this off on our taxes?
That's actually hilarious. Because facts and circumstances, do you need to go to Colombia to talk about business with your friend who lives in the United States? And it's sad to say, but it's a little bit more of a common sense type of thing, unfortunately, right? So if your friend is literally another state over or something of that sort, you guys don't need to go elsewhere to do something of that sort. So it's the facts and circumstances of the situation. If it doesn't fit, then it's not a write off, it's more pleasure. And then, even in doing something like that, there are different substantiation that needs to take place when you go travel, right? If you're traveling for business, you need to document what you're doing there. How is it related to your business? How is it helping your business? Those sorts of things. Because a person, for example, may have real estate in another country or another state that they travel to, look at, to maintain or manage or something of that sort. That's a travel expense because you're going to engage in business. Okay, so going out of the country, unless it's a team leader event with your staff, and this is something that you guys do, and it's helping the staff moral and things of that sort, that looks different. But if it's just, oh, my girlfriends, we're going out to another country, mm-mm. Let's revisit that facts and circumstances.
Like, I want to go on a vacation or my.
And then they may even argue, what is wrong with Zoom? What is wrong with Microsoft Teams? You don't have to do all of that just to meet, especially in today's uh, culture.
Now, in terms of things like technology, so people are
Mhm.
like, go get the newest Apple Watch, you can get the newest phone, all those kind of things. Of course, just like you said, people are like, you don't need to go out of town, you can use Zoom. Can you get the newest iPhone, the newest MacBook, all the newest, nicest technology and say, all right, I'm gonna write this off every single year?
You could, if the fact, and I sound repetitive, but if the facts and circumstance fit, then yes. Because here's the thing: if you purchase a phone, right, it has to belong to the business. It's not yours, it belongs to the business. That means the phone needs to have a separate line of which is used for business. And at any point, you can always pull a record from the phone company to track these business transaction via phone, right? So it's not, oh, the company buys a phone and I use it personally. You have to do a little bit more than that, because even a big issue for a lot of us as entrepreneurs, and this is what makes it so difficult for us to be entrepreneurs, is applying discipline and consistency. We see the things that are happening out there. People are doing this, they're getting these tax write-offs. Not always, but most times these folks have the discipline or the people behind them pushing them to apply discipline so that they can actually take advantage of these particular expenses, right? So oftentimes we'll see persons with two phones, right? Business phone and a personal phone. The business bought this. This is mine personally, right? So everything has to be, we just have to have a little bit more discipline in order to take advantage of these strategies that we see on TikTok, YouTube or things like that. But ultimately, it's that discipline. It's real.
Now, this is a great question. And Lovely Day, you got to tell us where you're looking. She says she has U.S. rental property and she plans to purchase internationally. When she
Mm-hmm.
looks at a property internationally, will she need to document the meetings with the real estate agents and so forth? Would that be enough for her to then be able to say this is a business expense?
So document it, yes. I'm sure those real estate agents, well, not sure, but maybe they'll have charger and expense or something of that sort. She want to make sure that she hold on to those invoices and just really document everything, literally everything, because we don't want to leave any holes in the floor, because that's just an easy way for the IRS to say, oh, look, see right there, it's not real.
And yeah, see that. I mean, now you got to just look for houses in all the exotic locations. Now, one thing I've seen a lot of too is like people buying cars and they're like, oh, I'm gonna buy, a brand new whatever in the business name. How
Mhm.
can you make that happen? How can you say, okay, yes, you can have, a G Wagon in the business name?
Okay, let me just make this quick statement. The information that we talk about today is general. It's not per one particular person. So every person needs to, head back to their tax advisor to really apply these information to themselves, not them doing it for themselves, but having the professional do it, right? As it pertains to the question that you just asked, okay, it's a big one. Everyone's doing it now, but it all comes down to the usage of the vehicle and how much you're able to prove things. Of course, you most certainly want to get it in the company's name, right? But outside of that, are you actually using it for business? Because we probably don't know that somebody might be watching us, right? And not saying that we should be constantly looking over our shoulder, but if we're doing what we're supposed to be doing, then we shouldn't have to look over our shoulder. So if we know it's not the right thing, then it's not the right thing, right? So if you are actually going to get a vehicle for the business, great, no problem, you can do that. Oftentimes, when folks do that and they say, you know what, I use this vehicle 100% of the time for business, oftentimes they have a second vehicle of which they can say, this is my personal and then this is for business. But if you have one vehicle and you have a lifestyle you want to live, how is it that one vehicle, business vehicle, is 100% used for the vehicle? How do you get around if you're not using Lyft? Right? So those sorts of things. And it's easy to lie, but it's better to do the difficult things so we don't have to face any issues later on. So if it's a case where, you know what, I use it at 80% of the time for business, okay, no problem. That's what we'll use. So it's just important that we actually can substantiate what it is that we are putting on paper.
Now, what are some of so if you don't have a business,
Mm-hmm.
what are some of the things that people should be looking at or trying to do before the end of the year to maximize
If
for
they don't have a business,
they don't have a business? So they're like,
uh-huh.
okay, I'm a W-2 employee. Should I
Mm-hmm.
write off my office? Should I bump up contributions here? What are the
Mm-hmm.
things that they might be able to do as a W-2 employee before the year comes to a close to reduce
Mm-hmm.
their tax liability?
So it's important to note that employees are not allowed to take write-offs for their home office or unreimbursed expenses that they incurred for the business that they work for. The tax code, unfortunately, is not written for employees, for W-2 workers. So it's oftentimes difficult for you to find a workaround because you're taxed at the highest. You're pretty much, everything that you have is taxed. There's not much that you can do outside of, say, maximize your IRA or your 401k, those sorts of things. Even if you were to say invest in the stock market, you have to do that strategically, where you're either tax loss harvesting or you're doing something else of that sort. But ultimately, the tax code isn't written in a way that give employees much deduction outside of retirement.
Unfortunately, that's so true.
Yeah.
Like so many people, that's why people like start a business and it's not so bad. Now, especially for certain industries. So right now, there's a lot of people in real estate. We've talked about real estate investing a lot as a community. And so, what are some of the things that people might not think about? Of course, they're thinking about, all right, the interest, crazy as that might be right now. They're thinking about the taxes and insurance that they're paying. But if you're a real estate investor, what are some other things that people might not be thinking about in terms of what they might be able to then deduct?
Yeah, absolutely. So some of the common ones is, of course, legal and professional fees. Are you paying a professional to do any sort of work for you? And that also includes your taxes that you filed, right? That's still a professional fee if they charge you to do that. Um, of course, if you have advertising and marketing, those sorts of things, if you have to get supplies and materials. So it all depends on where in the real estate spectrum that you fall on. Do you actually own a rental property? Now, if you own the rental property, of course, if you're traveling back and forth to that rental property, that's an expense that you can consider. Okay, of course, the cleaning, the maintenance, the repairs, those sorts of things. And folks, if you are paying your real estate and property taxes, make sure you retain those, because at the end of the day, all the expenses and deductions that you have, nobody else knows, only you. Therefore, you have to report it. The IRS knows nothing of that. The IRS may only know of the income portion of it. They don't necessarily care about the expense because they want to tax you on all your income if you allow them to, right? So all these sorts of expense, and oftentimes, what I would recommend for folks is when you're sitting down with your tax preparer or your tax professional, if you have questions that are sitting in a gray area, ask those. Don't be scared. Make sure you voice those, because at the end of the day, it could potentially be a business write-off, but you just didn't bring it up. And if the tax professional doesn't ask, then it's left unsaid.
Now, this is a good one. And I think I'll add another question to your question, Simone. She says, is it worth it to get a 2-bedroom apartment and write off an office if you have a remote side business generating around $10,000 a year?
That all depends. If Simone has, say, an actual business location, right? So let's say she has a shared office space, co-working space, or something of that sort. She cannot have a home office deduction plus that. Okay, she has to have either one or the other. So the home office deduction is only if she'll be using the home exclusively and regularly for business. Now, if she's going to use that space exclusively and regularly for business throughout the year, then that could definitely work in her favor.
Now, I think that's a good point, and actually made me think of one other thing. So people were often talking about like an office, but I do have a girlfriend who does kind of the virtual yoga, and so
Mm-hmm.
especially in this new virtual kind of world, and so she uses a room in her house for for us to kind of do the virtual yoga.
Mm-hmm.
Is that a place where she? I mean, obviously she doesn't have like the whole. I mean, she has like a camera and all those things, but she has a room that's dedicated to us to, jump in. I ain't that good, so whatever. But could she write off that space and say this is her yoga space that she does this virtual yoga or personal training or whatever that might be?
Yeah, if it's exclusive and regular to that business activity, then yes, because ultimately, if you're not using that space, where else would you be using, right? And you need that space in order to provide your service. So it's these keywords that I'm saying: need, required, and that puts facts and circumstance into position to really expose that benefit for any taxpayer, really.
See, and I think that's a really good point that I think people miss, especially as we've transitioned to do so many more things virtually. If you have empty space in your house, you may have now decided to like make bracelets in that empty space. And you're like, huh, I have this extra bedroom that I never put furniture in, and I have a table and chairs, and now I, make bracelets or whatever that might be. And it's just something that just may be missed in terms of
Exactly.
opportunity, especially in this virtual world. So many people
Yeah,
have.
and back to Simone's question, she had asked about if she had gotten 2-bedroom. I'm assuming she would be renting rather than owning. Now, with her renting, right, depending on how big those rooms are and the square footage actually being used, she could see herself writing off quite a bit, right, based on what she actually reported as earned income from the business. So it's definitely something that is oftentimes overlooked because of misunderstanding and unawareness, right? So every time I do a tax return, if I don't see rent as an item on the profit and loss, I'm asking about where was this activity done? Do you have a space exclusively and regularly used for business? Okay, I do. Okay, all right, perfect. Let me get the square footage of this, that, the rent here, the utilities. So it really adds up, and then your tax liability just starts falling and falling.
See, Simone, you might have just like wiped out a bunch of tax liability already, take away your rent liability just in that one thought process. And that kind of goes back to so many of the different industries. So there's real estate, but then we're seeing a lot of influencers. And
Mm,
so, I mean, the word itself is so broad.
I
But
know.
what are some things that influencers may not be thinking about in terms of what they could write off as well?
Hmm.
I mean,
All
they
right,
may have
so
the newest
so for
iPhone.
I'm sorry, repeat that,
They
please.
might need the newest iPhone and
Well, so that all depends, right? For any folks who are in a service industry, they're not necessarily providing a product or something of that sort. It's very it can be difficult for them to find expenses because they're not selling a product, right? So what I found is a lot of folks with consulting activities, influencers included, they don't have a lot of expense, and that's just a reality of it. But the smaller ones that they can think about, of course, is if they have software expenses, membership dues, and things of that sort. But where things really can step up is if those folks begin to put actual long-term strategies into place, right? Is the influencer gig just for this year, or are you looking to do it long-term? Is it a personal brand? What else are you looking to do? So that then takes us into a tax planning strategy session so that we can look at things that you have going on to determine how can we mitigate some of your tax liability for the future to come. And that includes the things that will pretty much fit your circumstance.
see, that's a good one. And that's too, and I think this is a great question. You talked about as you're sitting down with your clients, there are questions that you're asking. I'm sure not everybody, who you work with, how many people you've been working with and all that. What are some ways that they know that they're working with someone who's going to actually give them some tax planning, not just tax preparation? What are some things as they're interviewing people? Because this is a great time to interview and say, hey, I'm looking for somebody. It isn't the peak of tax season, so don't,
Mhm.
January 15th, and you're like, hey, would love to chat with you about your. How are
It's
people interviewing to find out if they have a good partner in the tax planning?
so funny. As you started talking, my smile went down, because it's definitely a hard concept for a lot of folks to understand and grasp. I always stress that there's a difference between your tax preparer, your tax professional, your bookkeeper, and your accountant. Your accountant can wear all of those hats. They can do all of those, or they can only do one of those. So you have to identify, what do you need and who do you need it from? A tax preparer literally prepares your return. Data entry, enters in, not saying that they don't know the tax code, but they're just pretty much doing the taxes. They're not necessarily having any year-round conversation with you. You just meet with them once per year. That's it. Once, done. A tax professional is usually your tax advisor, that person who advises you on different things. But it's important to note that an advisor and a preparer won't charge you the same. So know what you want and what you're willing to pay, right? The tax advisor will give you those tax strategies that you need to mitigate your tax liability. So in the long term, if you really look at it on a holistic level, that tax advisor can save you thousands. They may charge you a couple hundred, but they'll save you thousands, okay? Your bookkeeper, depends on what they do. They can just, maintain your books, review some stuff with you from time to time. Whereas the accountant, they may say, you know what, we only do financials, we only do auditing, or we only do taxes, or we do everything. So for me as an accountant, we offer full service accounting. So that's bookkeeping, tax preparation, payroll, business formation, all those sorts of things to help businesses not only set a solid foundation in place, but to also set themselves up for growth. right? So you have to, it's difficult to determine what you need when you don't actually know all of it, but pretty much you want to ask, have they worked with businesses? And sometimes industry specific can be the better route to go because they've had that long-term relationship within that industry. Couple of things is tell them about what you have going on so that they can begin to think about potential expenses. And one size doesn't fit all. I may be a great accountant to one and just not as good for you because of how I work, right? I tend to hold my clients accountable, well, try to hold my clients accountable so that they're on top of things. I've had folks that said, Rose, every time you ask me a question, I'm like, what? I don't, I'm getting better, but I don't know if I like getting better, you know? So you have folks who want that accountability and folks are just like, you're doing too much, just, I can't, I need to find somebody else. But it all depends on what it is that you're looking for and if you are willing to allow the grooming to take place.
Now, I think that's one of the things because people are also like, okay, does it need to be a person in my state? Or can it be, can they work with you if they live in California? Can they work with you if they live in Colorado? Where is there a location issue that people should be concerned about?
Not necessarily. The good thing about the United States, no, not really. Sometimes it's better, it is, I've seen it. It is better to sometimes work with someone who is familiar with the state because every state is different. So even though as tax professionals, tax preparers, we do federal income taxes, the state component is also just as important, if not sometimes more important than the federal, because a state like California or New York, they're pretty brutal when it comes on to taxes, right? So you want to make sure that, okay, do you have experience working with this particular state? Because they'll have a particular deduction that is not a deduction for the federal government, but it is for the state, or it's not a state deduction, but vice versa. So it all depends. So it does pay to have some sort of familiarity with that state.
I think that's a really good point because, the state tax part, we talk a lot about, federally what might work, but, you get into kind of some of the ins and outs, some of the details on the state, and you're like, wait, what? That doesn't make sense. How was I supposed to know that?
Exactly, because a prime example is, the state of New Jersey, your property tax can be written off, whereas Pennsylvania, they're like, what? Nobody cares about that. So it all depends on where you are.
Now, are there tax changes that we should be prepared for in 2023 versus what we've seen in 2021 and 2022?
Oh boy. Yes. So even though we're not seeing major tax changes, there's small ones here and there that's really going to throw a lot of us out of the park. And a lot of us may have already heard about this one, but it's the 1099Ks. So that's pretty much if you're being paid or having transactions done through, say, PayPal or Cash App, Venmo, you can anticipate looking out for a 1099K, which can make things a little bit difficult, especially if you were selling a personal item, or something like that. Because if it's personal, you're not expecting to pay taxes on it. But guess what? The IRS already has a copy of this. So they're pretty much waiting for you to report it to reconcile their system. So that's a major change that a lot of folks will want to look out for. Now, another one that's really coming in is the energy efficient vehicles. Right. So that's going to be a big portion of the change in tax code that a lot of folks, your Teslas, those sorts of things that folks may want to go ahead and purchase if it fits. And of course, energy efficiency for your house, those sorts of things. So anything that's pretty much geared towards climate change improvement, they're making a lot of changes in that arena.
And I think that's a really good point as you talk about the 1099K, because I'm in a couple of like the Black Girl minimalist groups. I'm trying to get rid of some. And so, of course, you selling some old shoes, couple purses that you don't use and those kind of things. And so what type of documentation do you need to show to say, hey, there's some junk in the closet. This ain't no business. Like this just a mess that
So here's the thing.
dust on them.
In the past, we've sold, personal items. We may sell a shirt or, computer or something of that sort. Technically, if you have a gain on that personal item, you should be reporting it on your tax return. Most of us don't because it
Nobody.
didn't really happen. Exactly. So now the IRS is like, oh, so y'all thought y'all was slick. Now I'm coming for you, right? So what this is doing is making sure that everything is accounted for. But for my folks who are just pulling something out the closet, it's going to be important that you know how much you paid for it, right? Because what you paid for it versus what you sold it for could be at a loss, which means you don't have to report that. But if it's at a gain, you do have a reporting obligation.
I think that's that's one of the things we got to figure out how to account for. Because I'm like, every time I look, I'm like, why do I have this stuff? What else?
So what some folks may want to consider, and I know Zelle have come out and said they're not a third party, so they're not tracking the way, say, Cash App or PayPal would. So they may want to switch and get a Zelle account to avoid all of that reporting if it's not necessarily business. Because a lot of people are going to be very surprised. And I do want to make a note for all my folks who buy stocks on Cash App, right? It's real. It's not a game. You're not necessarily just gambling, because whatever you do on Cash App gets reported to the IRS. And if it comes back and the IRS says you need to report this, you're like, I never sold stocks. I never had an account. People go back and forth. The IRS is like, no, they reported this under your social security number. So what I find that a lot of folks are doing, they're trading, they're selling stocks, they're buying stocks, but they're not tracking it. They're not accounting for it. And ultimately, it's going to hurt them because they're going to have to pay a lot of taxes on that, especially if it's short-term capital gain and they're in a higher income tax bracket.
And I don't think people are thinking about that. I think that and crypto.
Yes. It's a slow uphill for the IRS with crypto, but they're definitely coming into accountability with that. But it's really the folks who just, my sister told me to do this, or my brother said do that. And they're like, oh, I never did that. Yes, you did. Unless somebody's having fraudulent activities on your account, you did.
You did all those crazy tricks. And so this is a really good question. And it's funny, someone else asked me about this maybe a couple weeks ago. And so I'm actually going to do a show on this about creating your overall team.
Mhm.
And so this is, how does a financial planner fit into this if you already have a CPA and you already have a bookkeeper? And I think it's all these different labels. And one, knowing what people do, and sometimes people have a title, but they don't necessarily do.
Exactly.
So I'll let you answer this. I'll give a little bit of other thoughts as well.
See, it goes back to what I was explaining about the tax preparer, tax advisor, bookkeeper, and accountant. Find out what these folks do. What did you hire them to do? If you hired a bookkeeper to literally just keep your books, okay, no problem. Keeping your books. What is your CPA doing? Are they reviewing your financials with you on a quarterly basis, helping you put strategies in place? Are they doing your taxes? What are they doing for you? Don't just have somebody just to have them. Figure out if you need them. If you don't, well, I need a replacement. I need to make some adjustment, because at the end of the day, of course, you have to pay for these folks. And don't get it twisted. Even if you're paying this much for someone, that doesn't mean you're getting quality service. You get what you pay for. And I tell a lot of folks this, because you can't expect to pay a professional little to nothing for their expertise and their knowledge when they've spent and invested so much time to be able to provide you this guidance, this knowledge that you need in order to save thousands in taxes. So ordinarily, you want to know, why are they here? What do they do for you? Is it within your wheelhouse? First thing first, we need to, again, we just need to know what are they doing? Do we need them to do what it is that they're doing? So if your CPA is doing your taxes, great. What else are they doing for you?
And I'll piggyback and say that you need specialists and generalists.
Yes.
And so your generalist is typically going to be like that financial planner, because you may not know where to find a CPA, where to find an attorney, where to find, they're supposed to have their homies.
Mm-hmm.
Their professional homies to say, wait, you need to talk to so and so. It might be a point in time you need to talk to, or you need to build a relationship. So most people don't know an estate attorney like off the top of their head, and so you may need that. And so you'll have generalists and specialists. And so your CPA is going to be the specialist. Your financial planner should not be giving you tax advice. Like, no, they should have somebody, either your CPA that they talk to, or a CPA that they know that they talk to, and that is the specialist. They shouldn't be giving you legal advice. There are a lot of specialties that they shouldn't necessarily be making sure that everything speaks to each other.
Mm-hmm.
Sometimes, like, your CPA might conflict with your overall business strategy. So your CPA is like, girl, we're writing everything off. Like, you have no tax liability, and then your banker like, yeah, and you ain't getting no loans either.
Mm-hmm.
So
Exactly.
so your planner should come in and say, wait,
Hold
Rose,
up.
we don't need her to make X,
Mm-hmm.
because over here on the bank side, we are planning for this expansion of the business, and we're going to need to show enough income that we can qualify.
Exactly.
And so there's that kind of team approach of having the
Mm-hmm.
financial plan, the generalist that's saying, hold on, let me coordinate the people.
Mm-hmm.
And so you have people that are like, listen, my job is to make sure you pay the least amount of tax.
And with that too, I've met certified financial planners who are also EAs, meaning they also do taxes, right? And if you're an individual, you're really into retirement and stocks and those sorts of things, those are actually great persons to do your taxes. Right. But if you're looking for somebody to be more heavy on the business side and be a little bit more holistic, of course, you may want to go with a tax professional, an accountant, a CPA, or someone of that sort. But it all depends on what do you need. Because if you need business activity, business guidance, all right, yeah, your CFP may not be the best person to do your taxes. But depending on what they do, because I've seen great CFPs do great tax preparation.
And so I think that goes back, one, to know, know what you are and where you stand today, and know a little bit
Mhm.
about where you're going, so you can coordinate that team. But that just reminds me, I got to put that together, because it's really important to know your team. And I am anti, I know everything, I do everything. So anybody who says that ain't the person. You need to work with people who tell you what they know and what they don't know.
Exactly.
Tell you, like, I don't know that, but I know somebody who knows that. So you don't work with anybody who said they know everything. That's the major thing. So this is a good one, and I know a lot of people are doing this. So say they have an informal roommate type situation. So a friend that's like, I'm gonna stay with you for 6 months or whatever that might be, and they are paying them via Zelle to stay in the home. Do they need to report that income?
The straight up answer is yes, because you're renting out your home. Yes, you're renting out a room. Long-term rental, short-term rental, whatever it is, if they're there for a day or 60 days, it is supposed to be reported. See, for clients and I who have this conversation, I stress my professional advice, which is to report it. That's the appropriate thing to do, because at the end of the day, you don't want no problems, right? But if a client is adamant about not reporting it, that may be a client that I would disengage with because of those sorts of things. But ultimately, it's going to come down to the decision of the client.
But I think that's a question too, is okay on both sides. So yes, you should be reporting it, but now your home is not just your home, it's now a rental home.
Exactly.
And
Mm-hmm.
you may be able to get to a point where it's not so bad. It's not the, $4,000
Exactly.
that you're getting. And so you may be able to turn that into a positive as well. So I know it's like, I
Mhm.
don't want to report that, but
And I love that you just point that out, because the depreciation comes into place. You get to take a portion of your property taxes, your mortgage interest, those sorts of things. But we have to be strategic with it, because when you go to sell that home, whether you have it remain as your primary residence or ultimately turn it into, a rental, you're still going to want to be strategic. So if you're planning on doing something, anything financial, accounting, business, take it up with your tax professional. Okay, because at the end of the day, you don't want to make a decision that we can't retroactively fix. Those are very expensive, right? So if we know out the gate, this is what I plan to do, okay, let's see how we can let this work in your favor based on what you have going on and what we know you want to do. Because if I don't know, I can't help you.
Don't be hiding stuff. I know folks like she was like, hypothetically speaking. Hypothetically speaking, it's your homegirl. She doing that. Your homegirl went out of the room. We understand that piece. But now we are November the 1st, and there are certain things that you can do after December 31st. There are certain things that you can't. So we can still make an IRA contribution, but there are certain things we can't. What are some of those December 31st deadlines versus some of those after December deadlines of write-offs or contributions or things that we can do to impact our tax liability?
Yeah, so you just mentioned the big one after the 31st, which is those IRAs, Roth or traditional, or even SEP IRA contributions. But before, really, if you have a business, 31st is a cutoff. You can't really, you can't go over, except for certain circumstances where you may have employees and you have deferred compensation, and there's a certain timeline on that. But that all depends on, what's been accrued, what you have going on. So at the end of the day, it all depends. But ultimately, from a business perspective, your cutoff is the 31st.
And I have a question. I think this is a really good one, kind of depending on where you are right now and your overall planning and strategy. But it goes back to what you see online. And so I read this earlier today and I was like, oh my God, girl. So she said she didn't understand why she had a tax liability because she put money into her Roth IRA and then she took the dividends.
Okay.
Can you explain? Girl.
So you want me to explain the Roth IRA?
Yeah, just explain. Yeah, you could explain the Roth and then kind of explain why she's now having a tax liability when her understanding is she wasn't supposed to pay anything after she made her Roth contribution.
Okay, so it goes back to the root of a Roth versus a traditional. Okay, so the Roth is pretty much pre-tax, right? So actually, I'm sorry, post-tax. You contribute it into the IRA after you've paid taxes on it. Okay, the traditional IRA, you get a deduction for it if you're eligible for it. So it's pre-tax. So you get a deduction now, you pay taxes later. The Roth IRA, you pay taxes now, you take it out tax-free later. So if it's the Roth that you contributed, right, and you get a dividend is recognized in the year that it's received. So even if it was $20, you have to report that on your taxes so that you can pay the appropriate tax return, so you can pay the appropriate taxes. But the contribution into a Roth IRA, it's not a write-off.
Yeah, I was like, girl, oh my gosh.
See what?
It wasn't like a surprise tax liability. Like you'd be like, wait, what? Why? How they do this to me?
One of the not strange, but common things that I've seen, sometimes it's very difficult for folks to understand why they may owe, being that they have all this income. The more you make, the more you pay, unless you strategize to mitigate some of that tax liability. So if you are just self-employed, LLC, file on Schedule C, you can expect to pay quite a bit of taxes if your net profit is high, right? And that's where these different strategies that I've been mentioning comes into play, so you can mitigate some of that. So if you realize you're owing too much, it's a problem. You need to either have a conversation with your tax professional or you need to leave.
It's a big deal. Yeah. I mean, and too much taxes is relative because I don't care if I owe $1. I'm like, child, that's too much. People trying to kill me. Absolutely relative. But it's good to have a conversation. And I have definitely worked with people before, And I would say one of the best things was kind of a year over year analysis.
Yes.
Because, we living in the right now. And you need somebody else to say, girl, this is not as bad as you owe $3 last year. And so you kind of need someone to help and strategize in that respect as well. And so that goes back to kind of what you're looking for as you build your team, because some people are just like, here go your tax return, get out of my office.
Oh my gosh. I can't. So for myself, and this is foundational for me, I've done this since I started my practice. Every tax return needs to be reviewed with the client with the client and their spouse if it's a joint return. Meaning we need to see the tax return, whether it's in person or virtual. You need to see the line items, the numbers. I'm not saying you're a tax preparer. I'm not expecting you to understand everything, but you need to understand the impact and what you can or cannot do to change it. Right. So at the end of the day, we need to understand what's happening here, and let's address those questions right then and now, so we don't get amnesia later on and try to, what happened? This is what happened. We talked about it. Don't do that. You did it anyways. Or, hey, you took my advice and look at that. Last year you owe this. This year you're, getting a slight refund or, something of that sort because you listened and applied discipline. But ultimately, every tax return, actually cringe when new tax payers or tax clients tell me that they've never spoken to the person who did their taxes before. I'm like, oh no.
Like, hey, here go your tax return. Get up out of here. And lovely day. Yeah. And that's the thing. She talks about the Roth IRA example, because of course she could have taken those dividends later, had no issue, but it was the timing. And I think that's part of the issue is sometimes when we're hearing these items in like a social media type world, you may only catch I should just go do X. Like when the people are like, I can pay my kids and do XYZ. And you're like, wait, your kid 5 days old. Like what duty did they do? And so sometimes it's the bigger theory overall, but you didn't necessarily get all the details.
Yeah.
And so those details can be costly. I saw something and I meant to screenshot it this morning. I couldn't sleep. And it was a list of like all these things that you could do for your child. And it talks about 529s. It talks about like the UGMAs and the UPMAs and the custodial accounts and so forth. But what they didn't mention is what that does when it's time for them to go to school, because that's going to be counted towards what the family can contribute at a significant higher rate than if it was somewhere else. And so it was just like these things that are like quick snippets. It's like, wait, okay, what's your goal? Like, what's your plan? What do you want they're like, people are like, oh, put your child on. Don't do this. Put your child on. It's one thing if it's authorized on a credit card and you'll never give them the card. Okay, whatever. But if you put them joint on a checking account and they 16 and they decide
clear it out.
Yeah, exactly. And legally they can. And what can you do? They come home with some fancy, a night, some new shoes. Maybe they'd have bought some gifts for their significant other.
You see, the issue with that too, parents aren't teaching their kids, or not saying parents are in the position to do so, because not all parents are teachers, but they're not pretty much putting their children in a position to acquire how to use what it is that they're going to have in their possession at some point. Right. So that's why I've done my financial literacy classes with young people. I've done it in Jamaica because I see that it's a big issue. And even with folks wanting to have their children, have a Roth IRA, explain to them what does a Roth IRA mean. Not saying that they're going to fully get it, but have that conveyed to them. If they're going to go on payroll for your company, them earning this money, what does that mean for them? How can, walk them through these sorts of things. And again, not all parents are teachers, so it may be very difficult, but trying to get the resources necessary so that your child can learn about financial literacy at an early age, so they're not illiterate when they get older and lose everything that you've put in place for them.
I think that's a really good kind of concept overall. And as parents, you're trying to do the best for your child. And so you hear something and you're like, my mom ain't do this for me. I didn't know. Let me go ahead and do it. But it goes back to having some people on your team that you can say, hey, can I do this? Is my situation the same as that person's situation?
Exactly.
And then what are the impacts to me? Because it might be different if you make 50,000 versus if you make 150,000. And you want to go through that piece as well, because a lot of the benefits start to tear out, and they be like,
Mm-hmm.
you don't need no benefits. Um, Simone, oh my God, girl, she said the financial gurus recommend using the Roth as an emergency fund. Did you see me roll my eyes? Because the day you need your emergency fund is typically not the best day in the market.
If you're looking for something that is immediately, not necessarily immediately, but a savings account or emergency fund, the Roth ain't the way to go, because you're just pulling in tax burdens on yourself. 10% penalty. If that's the case, go to an online banking account that may be yielding, a percentage that could do something, right? But ultimately, it's better to go that way than to take on that 10% liability.
And don't be borrowing from your future. Like,
Mm.
today might be rough, but listen, as you get older, less and less people around to let you hold something, and their age discrimination is real. That ain't gonna go away. And I can't remember the article. I just read it maybe a few days ago, and it was like 40% of people retired before they intended to, and it was not their choice. So it could be medical, it could be to care for someone else, all those kind of things. Don't put yourself in a situation where you're like, oh yeah, my bad, because I needed new tires on the car. Now I can't eat. Like, no, that's
And then that's another thing too for folks to think about financially. When you have a retirement account, what does it mean when you take funds from it? Because that's oftentimes a surprise tax liability for folks. They may know about the 10% penalty, but they're not thinking about the fact that if it's a traditional IRA, right, or a 401k or something of that sort, it would be added back into your income because it was pre-tax. Therefore, now you have to pay taxes, ordinary income taxes on it, plus a 10% penalty. So it all just begin to add up rather quickly.
and you get a lot less than what you would have gotten in the beginning, which is it's super sad. I hate when I see people, they're like, listen, I did this. I'm like, I wish you would have said something before. That was bad.
See, that's one of those things that I'm saying. People need to say what it is that they want to do instead of do it and then try to retroactively fix it, because it's expensive to fix it.
Exactly. So just, I was thinking about, I was wondering if have a team where you could say, I was thinking, and they could be like, "Girl, don't do that. Don't." And hopefully it's somebody who knows you, so they already know your situation. You don't have to give them a whole bunch of background. You just be like, don't do that. No.
Exactly. And that's why with our clients here, I try to stress, hey, we're an asset to your team. Let us know what you got going on so that we can guide you, provide you with the information you need to go down the right path rather than go left and we got to come back and pull you over to the right. It's just too much knowing after the fact. It hurts you really, and then it just kind of makes us think, what were you thinking? We're here to assist you as you climb on the ladder of wealth.
Now, I've absolutely enjoyed this because it's so many. I feel like I'm gonna start screenshotting and keep a little folder when I see these things, and I'm like, that's true. That's half true, but not. I'm gonna have to keep that, and we'll have to come back and go back and be like, okay, here's one. This one. What you think about this one? Because
Listen,
I could not sleep last night. I was up at probably like 3, 4 o'clock this morning, and I'm like, somebody posted this.
I see. Listen, it's scary how the internet can be so great, but so awful at the same time. And us as humans, we have short attention span nowadays. We just see it. Oh, great. This is what we're gonna do. No, 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 no. We need to figure out, can we do it? And if we do it, what will happen? What's the pros and the cons? Not just seeing what's on TikTok or Instagram and these social media platforms and saying, oh, I'm going to do this just because it worked for them, or I want to do it because I saw it. No, no, no. Get the backstory. There's so much more behind it. For example, I've had folks who, oh, I did S Corp. Why did you do S Corp? Do you know the impact of an S Corp? They're like, no, I just saw it on TikTok. They said to me, oh, TikTok. is TikTok going to pay the IRS? No, they're not. So let's have this conversation before. And again, retroactively fixing, financial issues is very expensive.
So we are right up against time. I always like to ask this question. We are a community of women on our journey to financial independence, which is kind of rooted in the whole financially independent, retire early movement. But you might not want to retire early. It might just be that you want to do something different, change the way things are done, work 2 hours a day, whatever that might mean. And so I always like to hear, what does financial independence look like for you?
For me, debt-free, for sure. And being able to not just making sure that I'm well, but making sure that folks who don't have are well, making sure that, family members, if that, have what they need, right? So not just caring about what I have and what I need, because I'm pretty conservative, which works in my favor. I don't need too much, to get along. But for me, it's those folks who don't have, how can I impact the community of the impoverished people to, rise above?
I love that. We're getting there. We're going to get there, more and more Black women. And so somebody's watching this and they're like, listen, I need Rose in my life. How can they reach you?
For sure. Okay, so for me, I am on social media platforms as the Accountant Therapist. My company is Brown's Fulfillment Consultant and Accounting Firm. We are on social media platforms as at Brown's FCA. As it pertains to email, it's info@brownsfca.com. And then our website is www.brownsfca.com. If you are new to us, of course, we do offer an initial free consultation so that we can kind of, get to know you better to determine whether or not this is going to be a good fit or sorry, it's not going to work.
All right. I love it. And that is in the description as well. So check out the description if you're like, wait, what'd she say? Reach out. And so I want to thank you so much, everyone, for being with us tonight. Thank you so much, Rose. I hope y'all are taking notes and getting your taxes in order before December the 31st. Pull out those receipts, take some pictures before they fade and all that stuff too. So until next time, have a wonderful evening. Thank you, everybody.